Okay, our next lesson is something called banking and the money supply. And to get started, we're going to look at a couple of terms. The first term is what's called a financial intermediary. And that's a very fancy way of simply saying an institution through which savers can directly provide funds to borrowers. What kind of institution would deal with both savers and borrowers? And I'm sure all of you who are thinking right now are probably thinking, that sounds an awful lot like a bank. And it is. There are actually other kinds of financial intermediaries, but banks are the most common one. And the banks really are the ones we're going to be talking about in this course. So when we talk about financial intermediaries, we're talking about banks. All right, we need to know a few terms before we get into this lesson if we're going to understand the importance of banks to the economy and to the money supply. The first term is what's called an asset. And an asset is anything of value. It could be property. It could be cash, it could be a stock, it could be anything at all that people perceive to have value in some way that you own. That's called an asset. The opposite is what's known as a liability. A liability is something that you owe to someone else. So something that has value but you don't own and you owe to someone else. So for example, when the government sells a bond, that bond is a liability to the government because the government eventually has to pay back that bond. Assets are things you own of value. Liabilities are things you own of value, but that you owe to someone else. Okay, a term that we've sort of heard already, called the reserve, is money a bank has but does not loan out. And the best way I always think of this is in sports. A lot of times we'll say the reserve players are the ones who are sitting on the bench. You know, they're not in the game. Well, think of the reserves of a bank is the money that's sitting on the bench. The bank could use it, but so far it's chosen not to give out in the form of loans. It's just sitting there in the bank. Now, we've probably heard that term before because we've heard this term before. The reserve requirement. Now, I've changed the term slightly there. It says required reserve. Let me just distinguish between the two. The required reserve is the amount a bank must keep according to the Fed's reserve requirement. What does that all mean? Well, what it really means is that essentially there's a percentage of the money a bank has that it must keep in reserve. We know that already from our lessons on the Fed. The difference between the required reserve and the reserve requirement is subtle, but it's worth mentioning. The reserve requirement is the percentage of money that the bank has to keep. The required reserve is the actual amount. So if we have a situation where the reserve requirement is 10% and a bank has $200, then its required reserve is $20. So again, I'll say that again. In our little example there, the reserve requirement was 10%. The required reserve, because the bank had $200, was $20. So the reserve requirement is a percentage. The required reserve is a dollar amount. Again, I know that's a small subtlety, but it might confuse someone if they were reading along and didn't know the difference. The other type of reserve that we have is what's called an excess reserve. And that's extra money that the bank chooses to keep and doesn't loan out, but doesn't have to. And there's lots of reasons why banks choose to do that. We talked about earlier this year something called the discount rate, and that was the rate at which banks could borrow from the Fed. One of the reasons banks sometimes keep extra reserves or excess reserves is because they don't want to have to borrow from the Fed if that discount rate, let's say, is too high. Or they have a busy season coming up and they fear there may be a lot of people coming in to withdraw their money. They might decide to keep a little bit more money in the bank. There's lots of reasons bank might decide to keep excess reserves. We're not going to get into that much in this course. We should just know what they are. It's any amount beyond the required reserve that a bank decides to keep. And again, we'll use an example here. Suppose a bank receives a $100 deposit, the Fed's reserve requirement is 10%, and the bank decides to keep 5% in excess reserves. Now that means that the bank will loan out $85. It's keeping $10 in required reserves and $5 in excess reserves. All right, now that we have all that terminology down, we can move on to getting into the heart of today's lesson. The heart of today's lesson is what's called multiple deposit banking. I sort of lied a little earlier in an earlier lesson when I said that the Fed is the only one who controls the money supply. That's not really true, actually. The Fed is ultimately responsible for controlling nominal interest rates, as we learned. And they do that by changing the money supply to exactly where they want it. However, there's a lot of things that actually influence the amount of money in the economy. The Fed's job is to always bring it back where it wants. But one of those things that affects how much money is in the economy is the amount that banks deposit money and loan money. And I think the best way to explain what we're talking about here is to use an example. And we're going to start with a situation where we're going to assume we have a reserve requirement of 10% that's been set by the Fed. Okay, with that scenario in place, let's take a look at this situation. Okay, we're going to look at first Bank A, and we're going to assume that Bank A doesn't have any excess reserves. And by the way, my experience with most questions on the AP exam is that they assume no excess reserves. So we're going to start with that assumption here on this question. Doesn't mean it couldn't happen, but we're going to start with that. Okay, so we have a reserve requirement of 10%, and the bank is holding no excess reserves. All right, now, what we're creating here is what's called a T-chart. And you can probably sort of imagine why it's called a T-chart, because it sort of looks like a T. On one side of the T, we have what we talked about a minute ago, assets, and on the other side, we have liabilities. In basic accounting, T-charts should add up so that one side is equal to the other side. That means that all money is being accounted for. Now, in Bank A's case, let's suppose we have a liability, and that liability is a demand deposit of $100. Now, we used to just say checking deposits, remember, from our last module, but because that can now be ATMs and wire transfers and all sorts of stuff, that still counts as M1. We're going to call them all demand deposits. So we have $100 in M1. Now, from that $100, the banks can do a lot of different things. They could, for example, keep their required reserve, which they have to. In this case, because we have a 10% reserve requirement, 10% of 100 is $10. So they have to keep $10. That means they can, in this case, loan out up to $90. Now, they don't have to. They could have kept some in reserve, but in this case, we'll assume, to make things simple, that they loaned out all $90. Okay. So we have $100 in M1 sitting here in our liabilities column, and the bank then took that liability and turned it into an asset. And with that asset, they kept $10 and loaned out $90. Now, how does this actually affect the amount of money in the economy? Well, the story has to continue a little farther. Bank B comes along, and we're going to assume also that Bank B holds no excess reserves. Now remember, Bank A loaned out $90 to someone. Well, suppose that someone goes along and deposits their $90 in Bank B. Bank B also has a T-chart. And there's the $90. Bank B can now do something very similar to Bank A, because they also have $90 sitting in the account. So just as Bank A had $100 in deposits, this bank now has $90 in deposits. And again, they can loan out 90% of that. They must keep 10%, or they must keep $9 in this case. 10% of 90 is 9. That means they can still loan out 90 minus 9 equals $81. And we could continue the story. Suppose Bank B does in fact loan out their $81. And the person they loan that money to deposits all of their money into Bank C. Bank C then does pretty much what Bank A and B did. It puts the money into its T-chart. In liabilities, that bank can take the $81, and again, with the reserve requirement, it must keep $8.10 and can loan out $72.90. All right, now it seems like we can go on like this for quite a while. But what's important to note is what's happening to the money supply. Now remember, the money supply is any money that's in the form of cash or in demand deposits. So how much money did we start with? We started with $100, which went into Bank A. But you'll notice now there's $100 in Bank A, there's $90 in Bank B, and $81 in Bank C. And as long as all of that money that can be loaned out is loaned out and redeposited in another bank, every time we do that, we add more money to the money supply. So instead of having just $100 in the money supply, we actually have 100 plus 90 plus 81, which if we added all that up equals, it looks like $271. That's just simply because the banks loaned the money and the money was then redeposited in another demand deposit. Now, what's interesting is it seems like this could go on forever, right? Bank C could loan to Bank D, Bank E could loan to Bank F, and on and on and on. And every time that happened, the money supply would grow. Is that true? Well, it is. So wouldn't it be nice to have some sort of mathematical formula that we could determine how much this money could grow without sitting there and drawing a million billion T-charts? Well, it turns out there is a way to do that, and it's something called the money multiplier. Now, the money multiplier works like this. First, we should actually know how to calculate it. The money multiplier is equal to 1 divided by the reserve requirement, or M, and we'll use capital M to represent the multiplier, equals 1 divided by the lowercase rr. To illustrate, let's do an example. What is the money multiplier if the reserve requirement is 20%? Well, it's going to be 1 divided by 20%, which is really, don't forget, mathematically equal to 1 divided by 0.2, which if I do a little fractional adjustment becomes 10 over 2, which is really equal to 5. Here's another one. What is the money multiplier if the reserve requirement is 25%? Well, in this case, M is equal to 1 over 25%, which is really equal to 1 over 0.25, which again, by adjusting the decimal places, gives me 100 over 25, which is equal to 4. Generally speaking, these are basic fractions. If you have a hard time with fractions, it might be worth just memorizing a few of them. In particular, the money multiplier for 20%, 25%, 5%, and 10%. If you know those four, you should be in pretty good shape. It's not often they would ask any others because then round numbers become difficult. So generally those are some good ones to know. But to figure it out, what we're noticing is that we put the reserve requirement in the denominator, and that should give us what the money multiplier is. Now here's the really important part. What we should be noticing is that as the reserve requirement increases, the money multiplier decreases. Now, we haven't gotten too far yet, but what the multiplier is really going to do for us is it's going to show us how much money can grow if a bank can loan out money and people can redeposit that money. Well, what's the one thing that keeps money from being loaned out, or the main thing that keeps money from being loaned out and therefore keeps it from growing? The reserve requirement. So the more the Fed says to a bank you have to keep in the bank, the more the bank can't loan out, and therefore the more that the money will not multiply. So as the reserve requirement gets larger, the amount the money of the multiplier is going to decrease. Now, how do we put this into action? How much will the money supply grow? Using the money multiplier, we can answer that question without having to draw all those T-charts. So here we go. The formula, and this is sort of my own shorthand for this, M1, money growth, how much money M1 is going to grow, is equal to any new deposits in a bank times the money multiplier. So I'll use that shorthand, ND for new deposit for now, times N, the multiplier. And let's do an example to kind of make sure we understand. Suppose we've calculated the money multiplier to be 5, and a new deposit of $100 is put in a checking account. How much could the money supply grow? Well, what we know is that the answer is equal to $500. How do I know that? Because remember, how much M1 can grow is equal to the new deposit, we'll circle that here, times the money multiplier, the money deposit, the new deposit, times the money multiplier. In this case, 100 times 5, is equal to 500. So if the banks kept loaning that money out and people kept redepositing that money in new accounts, it could eventually grow. The $100 could grow to $500. Now you try. Suppose we've calculated the money multiplier to be 10 and a new deposit of 200 is put in a checking account. How much could the money supply grow? Stop the recording and give this some practice. Okay, hopefully you've had a chance to try this. Again, remember, M1 growth is equal to the new deposit, $200, times the money multiplier, which is 10. So we should have a total value of $2,000. 200 times 10 is 2,000. Okay, let's go ahead and put this all together. Here's a little practice problem. Suppose $500 is placed in a checking account at a local bank with a reserve requirement of 10%. The bank holds no excess reserves. Now, based on this, first question, how much can the bank initially lend out? Well, if the reserve requirement is 10% and the bank just received $500, that means it must keep $50, so it can lend out $450. Second question, what's the potential growth in the money supply throughout the banking system because of this deposit? Well, we know that we have to first find the money multiplier. And that is M equal to 1 divided by the reserve requirement. Or in this question, 1 divided by 10%, which is equal to 1 divided by 0.1, which is equal to 10 over 1, which is equal to 10. So we know our multiplier is equal to 10. And again, that's one of the ones I recommend memorizing if you have a hard time with fractions. Okay, now, to find how much this money can grow, we have to calculate the potential growth. And we do that with this formula. M1 growth is equal to new deposit times the multiplier, which in this case is $500 was our new deposit, times 10, which was our multiplier, which equals $5,000. So that money could grow, that initial deposit of $500 could grow to $5,000. Okay, let's have you try one now. All right, Abby moves $50 into her checking account. The reserve requirement is 20%, and the bank holds no excess reserves. How much M1 could this transaction create? All right, again, let's stop the video and do your best to figure out the answer. Okay, so again, what are we going to do? First, we need to find our multiplier. In this case, 1 divided by 20% equal to 1 over 0.2, which is equal to 5. Now that we know our multiplier, we can take and find our M1 growth, which is equal to the new deposit times the money multiplier. Well, she put $50 in, and our multiplier is 5, so the total amount it could grow should be $250. All right, there's one last wrinkle in the story here, and that is that it matters where the money comes from. What do I mean by that? Well, here's the thing. When we put that new deposit in the bank, if it was not, underline not, previously in the money supply, there's no change in procedure, so we're good to go. We've already learned how to handle that situation. However, if the money was already in the money supply, we must subtract the initial amount from the final potential growth. And if you think about it, it kind of makes sense. What we're trying to calculate here is how much can the money supply grow? Well, it's not really fair to include money that was already in the money supply in the growth. We can include all the new money that money created, but the initial amount really should come out. So what I want to do to illustrate this is give you an example that has two different scenarios built in. And our example is going to be a situation where we have $1,000 deposited into a checking account, which is a demand deposit, which is M1, with a reserve requirement of 20%. But in our first example, the money is going to come from a savings account, not in M1. And in that case, as I noted above, there's no change in procedure, and therefore the answer would be $5,000. And again, how did we find that? The multiplier we found was 5. The initial deposit was 1,000. 5 times 1,000 was 5,000. However, in example B, we're going to assume the money came from cash in someone's pocket. In other words, it was already in M1. So that final answer of 5,000, what do we have to do? We have to subtract the first $1,000. This $1,000 right here has to come out when we get our final answer, because remember, we're trying to see how much the money grew. Well, if the money was already in the money supply, that initial amount can't be added to our final total. And so we actually end up in that case with $4,000 of potential growth. Let's have you give this a shot. In your situation here, we'll have Teak, and he takes $20 from his pocket and puts it into a bank that is subject to a 10% reserve requirement. And of course, by the way, we're going to assume that account is a demand deposit. How much could Teak's deposit grow the money supply? Stop the recording and give it a shot. Okay, let's see how you did. First, we have to find our money multiplier. And we've done this enough times now that I think we know that the money multiplier is equal to 1 over the reserve requirement, which in this case works itself out to be 10. Now, to find the potential growth in money, we take the new deposit times the money multiplier, which is equal to 20 times 10, which is equal to $200. However, we're not quite done, because Teak's money was already in the money supply. His $20 came from cash, which is also in M1. So we can't count that money in whatever growth we're talking about. So we're going to subtract that amount from our final total, and so the answer ends up being $180. All right, finally, one last thought on this whole lesson. I think a lot of you have been saying to yourself, well, doesn't this seem kind of strange that we're assuming that all of the money is being loaned out and all of the money is being put back in the bank? I mean, after all, why would someone borrow money if all of it's going to be put back in the bank? And that's probably a reasonable question on your part. What we're trying to do, though, is just look at what could this money possibly be? How much could it grow? And it is true that in order for the money multiplier to be absolutely as powerful as possible, we are assuming two things. One, that all money is redeposited by borrowers, and that banks hold no excess reserves. If either one of those things doesn't happen, then the power of the money multiplier is not as powerful as it could be. And that's something worth noting. Okay, that concludes our lesson.